Hello everybody, it's Ivan from Cointuitive. Today I'm going to show you some work that I did on seasonalities. Seasonalities is an area that I started looking a few months ago, and today actually I'm going to look at the stock market. The main reason for that is that we all have heard sell in May and go away. So the suggestion is that the summer months are weak or weak on average for the stock market. And let's see whether this is true and back it with some numbers. So first of all, what is my approach? I have a Python script here, which what it does is it actually looks for consecutive periods of which on average, each of those periods on average is statistically significantly better than the average period of the same length. So for example, first, what is a period? When I started working on this project, I started by defining a month to be the smallest period. In other words, I was looking for sequences of 1, 2, 3 or more months which exhibit strong statistical properties. But then I decided, well, month is too long of a period, and there are certainly a lot of events that happened, especially around the turn of the month. So I ended up dividing the months in two parts. So first half and the second half. In other words, there are 24 periods per year. Each of them is a half-month period. And we are looking for a sequence of one or more half-month periods which exhibit strong directional moves. So now let's go to the script. It's very simple. It loads some Dow Jones historical data. Then we call two functions, best periods and half-month stats. So let's run this on the Dow Jones, and we are first looking at 15 years of history, which is a very short number of years. So here we go. What we see here, let's start with the second part, is the output of the half-month stats function. So it just outputs what are the statistics for the different half months. So we can see there are 24 of them, 2 for each month, the first half and second half. So immediately we see here that in March, for example, we had 15 observations because we are using 15 years of history. And the percent positive is 53%. The second half of March is very strong, 80%. Now, positive. Now, when we look further down, we see that there are some troubles in the first half of May. Second half of May is usually strong, but see how low is actually the rest. June is not a good month, July is okay, and then August is pretty bad. Actually, 46% for a half-month period to be below 50% is... Actually, the average is not 50%. For the stock market overall, I think for half a month, the average was something like 53-54% positive. So this is big deviation. And then we see how starting at the beginning of September, things actually get better until the end of the year. So there is really something into the months of the summer. They are kind of weak. So then let's go to the first half of the output. So these lines here are the output of the best periods function. So this function goes through sequences of different lengths. So here we discovered one period where we should be long in general of 2 half months. So that's like staying for a month in the market. We're buying in the end of March and selling at the end of April. So basically what it says is that April is a very strong month on average. We see the p-value, we see the percent positive. We have actually 87% positive on this kind of trade. And we have the mean and the median return. And actually a dump of all the returns over the historical. Then here we go, another 3.5 month period. So that's staying in the market for 1.5 months, buying in mid-March and selling at the end of April. And then we have a 6.5 month period, buying at the end of January and selling at the end of April. So nothing around the summer months. What is kind of interesting here that over 15 year period, this part here doesn't look that strong. That's kind of funny. So let's now look at something else. Let's change the history to 30 years and rerun the program. So we're going into a little bit more history. Again, you can see similar statistics. Strong second half of the year. August, bad. June, kind of not that great, and so on. But we have a little bit of more actually sequences that the program identified. Again, we see our buying in mid-April and selling at the end of May. No, actually this is different. This is staying until the end of May. Then here we go. The end of year, buying in mid-November and selling in mid-January. Then another 4.5 months, this is staying in the market for 2 months, end of February until end of April. Strong. Here we go, another end of year. But as you see, nothing in the summer months, nothing. But it also doesn't show as a short positions. I don't remember exactly what was the reason for that. But if we look actually even at more history, some of those will start showing, but for now we just have longs. But still, it's significant to see that there is nothing containing the summer months. And finally, just to convince ourselves that, you know, the Dow Jones is similar, let's take the S&P 500, again 30 years of history, rerun the program. Actually, not a lot of on the S&P 500, as you can see, it seems to be like less biased than the Dow Jones. It's much more, how to say, the patterns are not there. So I don't know. It looks like that it's based on historical data. We might expect that things may improve until the end of May, but then, you know, sell at some point, either beginning or end of May. Probably staying until the end of May might be okay, but then yeah, at least based on this data, it looks like it makes sense for one to avoid the summer months. That's all what I had for today. Hope you enjoyed, and until the next video.